Can your business survive a slow month without panicking? How about a 3-payroll month if you pay bi-weekly? That question comes down to one number, your working capital. And today we're going to break down what working capital is, how to calculate it, and how to know if you have enough. In general, working capital is the money left over after you subtract what your business owes in the short term from its short-term assets. The formula is simple: current assets minus current liabilities. So current assets include your cash, accounts receivable, and inventory. Current liabilities include things like accounts payable, credit card liability, short-term loans, and payroll obligations due soon. If that number is positive, then you have a general cushion to cover day-to-day expenses. If it's negative, you may struggle to pay your bills, even if your business looks profitable on paper. Note that working capital is a general measure of liquidity. You still need short-term cash forecasts looking out a couple of weeks, since assets like inventory and accounts receivable don't all convert to cash on the same schedule. A healthy working capital number won't help you if payroll is due Friday and your customer isn't paying you until Monday. And that dollar amount only tells part of the story anyway. That's where the working capital ratio comes in. So to calculate it, divide your current assets by your current liabilities. So if you have $150,000 in current assets, $75,000 in current liabilities, your ratio is 2. A ratio below 1 is a warning sign. It means your short-term obligations are bigger than your short-term assets. A ratio between 1.2 and 2 is generally considered healthy for a small business. It shows you can cover your bills with room to spare. On the other hand, watch out for a ratio that's too high. If you're sitting above 2, you might have too much cash tied up in inventory or receivables instead of putting it to work growing your business. So how do you actually increase your working capital? Well, it's not about moving cash between your bank accounts. So real improvement comes from growing the profit you keep in the business instead of distributing it out, refinancing short-term debt into longer-term loans, or bringing in additional equity or long-term financing. Those moves either add to your current assets or move a liability off your short-term books, and that's what actually moves the short-term liquidity number. Your working capital isn't just a number for your accountant. It's what determines whether you can grab new opportunity or cover a rough month without scrambling. So looking for more small business finance tips? Subscribe to our channel today.